Welcome, all finance enthusiasts. The SIE, Securities Industry Essential Exam, is an excellent way to begin your career in the financial investment sector. It encompasses the fundamentals of the industry and prepares you for more advanced examinations. Now let us continue preparing you to pass the Securities Industry Essentials, SIE exam. Let us begin with an overview of bonds. The previous segment described equity issuance, a method that corporations use to raise capital by selling an ownership interest to investors. Corporations can also raise capital by issuing bonds. Unlike shareholders, investors who buy bonds don't become part owners of the company. Instead, these investors become creditors. Essentially, think of purchasers of bonds as taking on the role of a bank by lending money to the issuer for a certain period. In return, the corporation agrees to pay these investors interest, as well as to repay the original amount of the loan when the bond matures. Although bonds are categorized based on the entity that issues them, all of these debt instruments have certain fundamental traits in common. This chapter will examine these common characteristics, while the next chapter will cover specific details related to bonds that are issued by corporations, the U.S. government, municipalities, and other borrowers. Introduction to debt instruments. Basic bond characteristics. A bond is a contract between an issuer and an investor. As stated previously, the investor lends money to the issuer and the issuer, debtor, promises to repay debt service. Debt service represents the total of all interest payments over the bond's life and the final repayment of the loan value, principal, at maturity. For an issuer, raising capital through debt is referred to as leverage financing since the issuer is borrowing against its net worth. When a corporation has more debt than equity outstanding, it's considered a leveraged issuer. Let's examine some key terms that are used when describing bonds. Par value. The par value of a bond, also known as the principal or face value, is the amount that the issuer agrees to pay the investor when the bond matures. An investor who buys a bond with a par value of $1,000 expects to receive $1,000 when the bond reaches maturity. Regardless of the amount an investor pays for a bond if held to maturity, the issuer is obligated to pay the par value. Most bonds are issued in multiples of $1,000, although some, like U.S. Treasury securities, may be issued in denominations as small as $100. Coupon rate. Obviously, investors do not buy bonds just to receive their principal back at some future date. The issuer must also agree to pay investors interest on the loan until the bond matures. The interest rate is generally fixed at the time the bond is issued, and with some exceptions remains the same for the life of the bond. This fixed interest rate is also referred to as the bond's coupon rate. The interest paid is calculated based on the bond's $1,000 par value, not the price paid for the bond. Generally, bonds with longer maturities offer higher coupons. Since the investor's money is at risk for a long period, they expect a higher rate of return than those offered by shorter-term investments. Short-term bonds are usually safer investments since buyers know that their money will be returned relatively quickly. For this safety, investors are willing to accept lower interest rates. Of course, other factors may affect the yield of bonds. If an issuer is considered a high credit risk, it must offer higher yields to attract investors than an issuer with a higher credit rating. The term yield is used in different ways. In some situations, yield may refer to the return on an investment. However, in the case of a debt instrument purchased at par value, it refers to the interest payments. To determine the amount of interest that the investor will receive annually, the bond's par value of $1,000 is multiplied by its stated interest rate. For example, if a client purchases a 6% corporate bond, she will receive $60 per year. $1,000 times 6% equals $60. Since bonds usually pay interest twice per year or semi-annually, the investor will receive two $30 payments every year. $60 divided by 2 equals $30. The bond's maturity date is important in determining when an investor will receive her interest payments. One of the payment dates will always be the month and day of maturity, while the other is 6 months from that date. Therefore, if the investor's 6% corporate bond matures on June 1, 2030, she will receive 2 payments per year, one every June 1st and the other every December 1st. Fixed or variable rates. As previously mentioned, a bond's interest rate is set at the time of issuance and generally remains fixed for the life of the bond. However, in some cases, as interest rates fluctuate, the coupon rate will be adjusted to reflect market conditions. These adjustable rate bonds are sometimes referred to as variable or floating rate securities. Initial interest payment. Traditionally, bonds pay interest on the 1st or 15th of the month to ease paperwork issues. However, newly issued bonds pay interest from the dated date, which is the date from which interest begins to accrue, and this may not fall on the 1st or 15th. For this reason, the very first coupon on a newly issued bond may be for more or less than the traditional 6-month period, as the issuer tries to synchronize with the 1st or 15th payment date. If the first coupon is for more than 6 months, it is referred to as a long coupon. If the first coupon is for less than 6 months, it is referred to as a short coupon. Accrued interest. Since bond interest is paid semi-annually, a bondholder who sells a bond between interest payments is usually entitled to the interest earned during the period when they still owned the bond. This accrued interest is the amount of interest that the seller is entitled to receive from the buyer and the amount that the buyer is required to pay to the seller for a bond being sold in the secondary market. For calculation purposes, corporate and municipal bonds use 30 days in every month and 360 days in the year, while U.S. government T-notes and T-bonds use actual days in every month and 365 days in the year. Zero-coupon bonds do not pay periodic interest. Instead, an investor purchases a zero-coupon bond at a significant discount from its par value, but redeems the bond for its full face value at maturity. The difference between the purchase price and the amount received at maturity is considered the bond's interest. Maturity date. This is the date when the bondholder will receive the $1,000 return of principal from the issuer. The maturity or due date is indicated on the face of the bond. Serial versus term issues. Corporations and other entities commonly issue millions of dollars worth of bonds simultaneously. There are several ways an issuer may structure its loan repayment. Two common types are term and serial. If all the bonds in an offering are set to mature on the same date, it is referred to as a term bond issue. Conversely, if parts of an offering mature sequentially over several years, it is referred to as a serial bond issue. For example, an issuing corporation may sell $50 million in par value of bonds with $10 million due each year over a 5-year period. With serial issues, an investor can purchase a quantity of bonds that mature at the same time, or, if she prefers, she could purchase bonds with different maturities. A serial bond may be structured so that principal and interest payments represent approximately equal annual payments over the life of the offering, a structure known as level debt service. In some cases, an issuer may structure an offering so that a portion matures serially, with a significant portion paid off at the final maturity. This is called balloon maturity. Why bond prices fluctuate from par. The par value of a bond can greatly differ from the price an investor pays to purchase it, that is the market price. Although most bonds are initially sold at par value, over time, these bonds may trade in the market at prices that are lower or higher than par. A bond sold for less than its par value is said to be selling at a discount, while a bond sold for more than its par value is selling at a premium. Discounts and premiums. The reasons for these discounts or premiums usually relate to changes in prevailing market interest rates, that is, interest rate risk, or concerns regarding the issuer's creditworthiness, that is, credit risk. Let's analyze these two risk factors carefully. Interest rate risk. Investors who purchase bonds take on the risk that the bond's market value may decline if market interest rates rise. Interest rate risk indicates that as market rates increase, investors will be less interested in buying existing bonds at par since they can obtain higher yields by purchasing new bonds. Consequently, existing bonds will need to be offered at a discount, that is, put on sale to attract buyers. Conversely, if interest rates fall after a bond has been issued, the bond will likely trade at a premium to par. Generally, when interest rates change, the prices of long-term bonds will fluctuate more than those of short-term bonds. This means that bonds with longer maturities carry more interest rate risk than short-term bonds. However, it is crucial not to confuse this with which rates are more volatile. Short-term interest rates tend to change more frequently and drastically, they're more volatile than long-term rates. A more detailed description of interest rate risk will be discussed much later in the series. Credit risk. Credit risk acknowledges that an issuer may default and fail to meet its obligations to pay interest and principal to bondholders. Not surprisingly, issuers deemed to be high credit risks must offer a higher interest rate to persuade investors to purchase their bonds. Generally, if a company is perceived as becoming riskier, the prices of its bonds will fall. However, if a company is viewed positively, its bond prices tend to rise. Measuring credit risk. Securities issued by the U.S. government have the lowest possible credit risk because the government's risk of default is virtually zero. This is due to their backing by the full faith and credit and taxing authority of the U.S. government. Evaluating credit risk is more challenging for bonds issued by corporations or municipalities. Most investors rely on specialized organizations to analyze the credit of bond issues. Notable credit rating companies that provide bond ratings include Moody's, Standard & Poor's, S&P, and Fitch Investors Service. Each company assesses the likelihood of an issuer defaulting and assigns a credit rating to the issue. Over time, this rating may be adjusted based on subsequent events. A lowered credit rating may lead to a significant drop in a bond's market price. For bonds issued by corporations, Moody's further subclasses each major rating category using a 1, 2, or 3, with 1 being the highest. For instance, AA1 is higher than AA2, while AA3 is superior to AA1. Standard & Poor's employs a plus, and minus system to further differentiate between ratings. For example, A+ is better than A, however, A is superior to BBB+. It's important to remember that only relatively large issues receive ratings. This does not necessarily imply that an unrated issue is of poor quality. Instead, it may indicate that the issue is too small to qualify for a rating. Bond pricing. A bond's price is typically expressed as a percentage of its par value. For example, a bond priced at 100 is selling at 100% of its par value, or $1,000, 100% of $1,000. A bond priced at 90 is selling at a discount equivalent to 90% of its par value, or $900. A bond priced at 110 is selling at a premium, which equals 110% of its par value, or $1,100. A bond's price can also be expressed in points. Each point represents 1% of the bond's par value, which equates to $10. Therefore, a quote of 99 points equals $990. 99 points times $10 per point equals $990. A bond selling at 100 is priced at 100 points or $1,000. If the bond's price rises to 101, it will be selling for $1,010, 101% of the par value. A bond's price can also be expressed in points. Each point represents 1% of the bond's par value, which equates to $10. Therefore, a quote of 99 points equals $990. 99 points times $10 per point equals $990. A bond selling at 100 is priced at 100 points or $1,000. If the bond's price rises to 101, it will be selling for $1,010, 101% of the par value. Smaller pricing increments. Bonds do not always trade in whole point values, their prices frequently include fractions. Traditionally, corporate and municipal bonds trade in increments of 1/8 of a point, while treasury notes and bonds trade in increments of 1/32 of a point. For pricing purposes, instead of working with fractions, we convert the fractions to decimals by dividing the numerator by the denominator. For example, 1/8 becomes 0.125, 5/8 becomes 0.625, and 15/32 becomes 0.46875. Therefore, a bond quoted at 93 5/8 would be converted to 93.625% of par, or $936.25. Prices and yields, an inverse relationship. A bond's coupon, or interest rate, is typically fixed for its entire life. As market interest rates change, new bonds will be issued with either higher or lower coupon rates than those of existing bonds. To keep pace with current interest rates, the values or market prices of existing bonds will adjust based on the relative coupon rates of existing and new issues. As mentioned earlier, if interest rates rise, the value or price of existing bonds will fall since the demand for existing bonds that offer lower interest rates decreases. Conversely, if interest rates fall, the value or price of existing bonds will rise as they become more valuable than new bonds issued with a lower coupon. Thus, there exists an inverse relationship between market interest rates and existing bond prices. Calculating bond yields. Like any investor, a bondholder is focused on determining her investment's return or yield. There are three different measures for determining a bond's yield: nominal yield or coupon, current yield, which is annual interest divided by current market price, and yield to maturity, or effective return. These three types of returns will be covered in detail in later videos. Call provisions. A bond offering may include a call provision, which allows the issuer to redeem its outstanding bonds before they reach maturity. If called, the investor receives the full return of principal plus any accrued interest. From the issuer's perspective, the benefit is that it is no longer obligated to make periodic interest payments once the bond issue has been called. One primary reason that issuers opt for callable bonds is to capitalize on declining interest rates. Call provisions. A bond offering may include a call provision which allows the issuer to redeem its outstanding bonds before they reach maturity. If called, the investor receives the full return of principal plus any accrued interest. From the issuer's perspective, the benefit is that it is no longer obligated to make periodic interest payments once the bond issue has been called. One primary reason that issuers opt for callable bonds is to capitalize on declining interest rates. To entice investors into purchasing callable bonds, their yields or coupons are typically higher than those of non-callable bonds. Call protection and call premium. Most callable bonds impose a restriction on how soon the bonds can be called, typically 5 to 10 years after the date of issuance. This is known as call protection. If the call protection period expires and the bonds are subsequently called, the issuer is often required to pay the bondholders more than the par value to compensate them for the early redemption of the bonds. This additional amount is known as a call premium. For example, in January 20XX, an issuer sold bonds that mature in 20 years. Beginning 10 years after issuance, the bonds are callable at 102. If a bondholder buys one of these bonds and the issuer calls it back after 10 years, she will receive $1,020, which is $20 more than the bond's par value. The call protection provides the investor with the assurance that her bond cannot be called for 10 years. For example, in January 20XX, an issuer sold bonds that mature in 20 years. Beginning 10 years after issuance, the bonds are callable at 102. If a bondholder buys one of these bonds and the issuer calls it back after 10 years, she will receive $1,020, which is $20 more than the bond's par value. The call protection provides the investor with the assurance that her bond cannot be called for 10 years. Call types. Some calls are in whole, meaning the entire issue is called at once. Other calls are partial, also known as lottery calls, meaning that some of the bonds will be retired early while others remain outstanding. Finally, some bonds may have catastrophe call provisions, which are enacted only if the bond's underlying collateral is destroyed. For example, a bond is issued to generate funds for constructing a bridge. If the bridge washes away due to severe flooding, the issue may be called, and the bondholders will be repaid with insurance proceeds. Both partial and in-whole calls must be disclosed to a client before purchasing a bond and noted on the confirmation. This feature gives the bondholder the right to redeem the bond on a specified date or dates before maturity. For bonds with the put feature, their yields are generally lower and prices higher since bondholders can redeem their bonds if interest rates rise. Convertible bonds. A convertible bond allows an investor to convert the par value of the bond into a predetermined number of shares of the company's common stock. For the purchaser, the trade-off for this opportunity is that convertible issues typically offer lower coupons than similar non-convertible issues. If the bonds are converted, the debt becomes equity, significantly altering the issuer's capital structure. For example, if Warp Inc. issues 10% convertible bonds with a conversion price of $40, the conversion ratio is 25 shares for each bond. In other words, the bondholder can exchange the bond and in return, receive 25 shares of stock. The conversion ratio indicates the number of shares an investor receives when surrendering a $1,000 face amount of bonds. For example, if Warp Inc. issues 10% convertible bonds with a conversion price of $40, the conversion ratio is 25 shares for each bond. In other words, the bondholder can exchange the bond and, in return, receive 25 shares of stock. When the conversion ratio is multiplied by the conversion price, the result will always equal $1,000. Therefore, conversion is immediately profitable if the underlying stock trades at a premium to the conversion price. Whether it's worthwhile for investors to convert their bonds into stock largely depends on the underlying stock's price compared to the market value of the bond. For example, let's assume that Widget's bond is convertible at $40 and is trading in the market at $85. Widget's common stock is currently trading at $35 per share. What's the best choice for the investor? Selling the bond or converting it to stock and selling the stock? If the bond is sold in the market, the investor will receive $850, 85% of par. On the other hand, if the bond is converted into 25 shares, $1,000 divided by $40 equals 25. Those shares could then be sold for $35 each, resulting in sales proceeds of $875, 25 shares times $35. Therefore, the best choice for the investor is to convert the bond into stock and sell the stock. For example, let's assume that Widget's bond is convertible at $40 and is trading in the market at $85. Widget's common stock is currently trading at $35 per share. So what's the best choice for the investor? Selling the bond or converting it to stock and selling the stock? Advantages and disadvantages of convertible bonds. Convertible bonds allow corporations to borrow money at a lower rate or lower coupon because the convertible feature is attractive to investors. Investors are willing to accept the lower interest rate in exchange for the opportunity to convert the bonds into common stock. Additionally, the investor has some downside protection because, even if the stock price falls, the convertible bond still has inherent value as a bond. Advantages and disadvantages of convertible bonds. Convertible bonds allow corporations to borrow money at a lower rate or lower coupon because the convertible feature is attractive to investors. Investors are willing to accept the lower interest rate in exchange for the opportunity to convert the bonds into common stock. A disadvantage of convertible bonds is that if all the bonds are converted into stock, the number of outstanding shares may increase dramatically. From the issuer's perspective, conversion adjusts the mandatory debt obligation into equity and deleverages the corporation's balance sheet. This deleveraging is beneficial as it eliminates both near-term and long-term debt service obligations. Remember, dividend payments to common shareholders are voluntary, whereas interest payments to bondholders are mandatory. Therefore, after conversion, the former bondholders are no longer owed money at maturity. This deleveraging is beneficial as it eliminates both near-term and long-term debt service obligations. Remember, dividend payments to common shareholders are voluntary, whereas interest payments to bondholders are mandatory. Forced conversion. Most convertible issues are callable, giving the issuer the option to redeem the bonds prior to maturity. However, if the call, redemption price of the bond is less than its conversion value, the bondholder could be forced either to convert the bond immediately or to accept less than its conversion value. For example, Rob owns a corporate bond that is convertible at $40. With the underlying stock currently selling at $45 per share, the corporation indicates that the bond will be called at $150 on the next call date. If Rob asks his RR what action to take, what should she tell him? Rob's RR should recommend that he convert the bond to stock since the shares would be worth $1,125, while he would receive only $1,050 if he allowed the bond to be called. Conversion is not taxable. If the owners of convertible bonds or convertible preferred stock convert those securities into common stock, the conversion is not a taxable event. When these securities are converted, the cost basis for the common stock received is based on the cost basis of the original security. Conversion is not taxable. If the owners of convertible bonds or convertible preferred stock convert those securities into common stock, the conversion is not a taxable event. When these securities are converted, the cost basis for the common stock received is based on the cost basis of the original security. A taxable event occurs only when the investor subsequently sells the acquired shares. For example, if an investor purchased a convertible RFQ corporate bond for $1,200 and converted it into 40 shares of common stock, the investor's overall cost basis is $1,200, while her cost basis per share is $30, $1,200 divided by 40 shares. If the stock was later sold for $32 per share, she would report a capital gain of $2 per share or $80. For example, if an investor purchased a convertible RFQ corporate bond for $1,200 and converted it into 40 shares of common stock, the investor's overall cost basis is $1,200, while her cost basis per share is $30, $1,200 divided by 40 shares. If the stock was later sold for $32 per share, she would report a capital gain of $2 per share or $80. In our next video, we will examine the characteristics of specific types of bonds, including corporate issues, U.S. Treasury and agency securities, and municipal issues. Additionally, we will describe the various methods of underwriting these securities. As we conclude this segment, we invite you to show your support by liking this video and subscribing to our channel. It is a simple click for you, but a huge support for us, and it is entirely free. Please turn on your notifications to be among the first to be notified as we go into greater detail about bonds and excel in the SIE exam. Thanks.